Good morning, everyone. Thank you for joining us for today's webinar, Understanding the Employee Retention Credit, a deep dive into the new stimulus bill, presented by Ray & Associates, a top 100 regional CPA and business consulting firm with offices across Ohio. My name is Imani Fields, and I'll be walking you through a few housekeeping items. First, if you have any questions during today's presentation, you may enter them into the chat box on your screen. We know that we will not be able to get to them all, so we'll try to answer your questions at the conclusion of today's presentation. When you receive this email, you'll also receive the recording of today's presentation, as well as a link to participate in a verified evaluation. Please take a few minutes to share your thoughts about the presentation as a whole, the information provided, and the presenter. Your feedback is important to us as we determine future webinar topics. Also, if you'd like a copy of today's slides, you'll find that they're available in the Handouts section of the webinar dashboard on your computer screen. Today's webinar will be given by Speece, Dee Gray, and moderated by Doug Hauser. Greg Speece is a principal at Ray & Associates working in tax services. Greg brings more than 10 years of experience providing tax planning and compliance for privately held businesses and their owners, with a focus on manufacturing, distribution, and construction industries. Dee Gray is a client service specialist at Ray & Associates, serving as the payroll services manager. Dee has more than 15 years experience in the accounting industry, and her areas of expertise are payroll, payroll taxes, and QuickBooks. Finally, Doug Hauser, our moderator, is a principal and director of Ray & Associates Construction and Real Estate Practice. Doug oversees the firm's efforts in growth and relationship management for his client segment. More than 25 years of experience, Doug's focus revolves around finance reporting considerations and guidance for the firm's construction clients and third-party financial statement users. And I apologize for a little bit of echo. It should subside now, but I'm going to pass it on to you, Doug.
Thanks so much, Imani, and welcome everybody. Obviously, this is a very complex and nuanced topic. A lot of amendment a lot of change that has come down the pike here with the most recent CARES Act amendment. So glad we have Greg and Dee on today. Greg is our expert on this topic from a tax perspective, and really is our firm resource when we get into topics such as this. So glad to have his expertise, although there's still a lot of unknowns. I will warn everybody, and obviously every situation is very fact specific, but a lot of interplay between this and the PPP, of course, which we'll get into. And Dee, so glad we have Dee on the line as well, because Dee is our utmost payroll expert and knows all things payroll and payroll related, and has a wealth of experience for us on that side. So the interplay between these two areas obviously is significant, and we'll get into that. So with that, any initial thoughts, Greg, and then Dee, before we get started here?
Well, yeah, thanks, Doug. I mean, I think you hit the nail on the head here. You know, there's a lot of unknowns as we go through this. So I've tried to kind of structure the presentation in a way that, you know, turns the clock back to the original enactment of the CARES Act and then moves forward to really fully understand all the changes that were enacted in this most recent legislation. There are some changes that are retroactive and some are only forward-looking. So, you know, we're all still trying to understand the implications, and, you know, we're expecting guidance, but this has only been law for a couple of weeks, so we really don't have anything other than the actual bill text at this point.
Yeah. Dee, any quick thoughts before we get started?
Yeah, I agree with what you guys have both said. We're going to be looking for further guidance. This is just what we know now. We're going to learn more about it, I'm sure, every day. So stay tuned.
Excellent. Well, with that, Greg, go ahead and let's get started.
Thanks. So, like I said, the employee retention credit really dates back to the enactment of the CARES Act back in March of 2020. And this was a tax credit that was designed to encourage employers to keep employees on the payroll. And, you know, we had a lot of clients that, you know, effectively didn't pay much attention to this credit because there's a provision within the CARES Act that said if you obtained a PPP loan, then you did not qualify for this credit. So, you know, the reason that we're all here talking about this in January of 2021 is the new stimulus bill that came out at the end of December removed that provision retroactively. So now you can in theory, qualify for both a PPP loan and the employee retention credit. And there's, some interplay that we'll get into and how that's going to work. But, as far as this presentation goes, I wanted to start with an overview of the rules under the CARES Act, because that's the foundation, for both credits. And then we're going to look at the changes that were made in Section 206 of the Consolidated Appropriations Act. Those are the retroactive changes to the credit. And then there's some changes that were made in the following Section 207 that are the prospective changes that apply to 2021 going forward. So it's very important to distinguish those two sections because they have different eligible dates. And what it effectively did was create two versions of this credit going forward. So we have the credit and the rules that apply to 2020, and then the rules that are going to apply to 2021. So with that, if you really look at the first slide here, or can you give me so the first slide here, we have just a short summary of what the credit is. It's a refundable payroll tax credit for 50% of qualifying wages paid by an eligible employer whose business has been impacted by COVID-19. Now, those wages are capped under the CARES Act rules to $10,000 per employee for all quarters. So basically, $10,000 per employee per year at a 50% rate. The maximum credit for 2020 would be $5,000 per employee. Now, there are two key terms in there that we're going to have to understand whether or not you're eligible. One is what are qualifying wages, and another would be what is an eligible employer. So first, if you want to look at who a qualifying employer is, you must fall into one of two categories. The first, either your business is fully or partially suspended by a government order due to COVID-19 during a calendar quarter, or you experience a significant decline in gross receipts during a calendar quarter. So really, this is an either or test, which basically means, if one of the two apply, then you may be eligible for that quarter. If we look at the first test, fully or partially suspended by government order, that is only, so the wages paid are only applicable to the period that you're actually shut down, which I think is kind of important. So if you had at the beginning of a quarter, you were shut down, and then that was lifted before the end of the quarter, you wouldn't qualify for the entire quarter, just the duration of that government order. So, there's some guidance out there on what constitutes a full or partial shutdown. And really, all we have at this point is frequently asked questions on the IRS website that go through some scenarios, but they don't encompass all situations. So that is somewhat subjective. Then we have this mathematical test for whether or not your business has a significant decline in gross receipts. And basically, the way that this works is you have a beginning to the period and an end to the eligibility period. And your eligibility period would begin when your gross receipts are below 50% of the comparable quarter in 2019, so a greater than 50% revenue decline. And then you would continue to be eligible until the quarter in which you bring that revenue back up to, or I should say gross receipts back up to an 80% threshold compared to the prior quarter. So it has a beginning and it has an end. All quarters in between that, you would be qualified based on that criteria. And I guess the last point on this slide before we move on is, we get a lot of questions as far as how do you determine gross receipts for this test? And the regulations point back to Internal Revenue Code 448C, which is basically, gross receipts from all sources. It's a very broad definition of gross receipts. But the other important thing to point out is it stipulates that you should be using the method of accounting that you use to determine your federal income taxes. So if you're an accrual method taxpayer, you'd use the accrual method. If you're a cash method, you should be using a cash method for this. And, if you also think about things like if you're required to use percentage of completion, that technically would be required to be done to figure out your gross receipts for that period. So I know that not all clients are doing that on a quarter-by-quarter basis. So it could involve some additional steps to kind of look at those tests and see if you meet the criteria. Next slide, please. So now that you've determined whether or not you qualify as an employer, do you have qualifying wages? That's the next term we need to define. And the definition of qualifying wages can differ depending on the size of your organization. So if you are an employer with less than 100 employees, and this is determined based on full-time employee equivalents, which is 30 hours or more per week. If your employer had 100 or fewer employees on average in 2019, the credit would be based on wages paid to all employees, regardless of if they worked or not. If you are an employer with more than 100 employees, the wages would be determined only for wages paid to employees who did not work during the calendar quarter. So that could be a very big difference for those larger employers. It's only going to be wages that are paid to employees who are still being paid but sent home. Next slide, please.
Hey, Greg, we've got a couple quick questions here that I thought are relevant. One, we get a lot of this if a business has different locations or business units, and say one business unit might qualify, but overall perhaps not. Any guidance yet on how we would handle something like that?
Yeah, there is out there on the IRS website, and I have a link to it at the end of this presentation. There's a whole host of frequently asked questions, and they're categorized by different topics. And it does go into there are affiliation rules as far as what constitutes a single employer for purposes of that previous test that we just talked about. And so there are some examples on there, and really that's a situation by situation determination. So it's hard to just go into those rules in a webcast like this in the interest of time. So we're not going to really get into those rules, but that is out there, and there are affiliation rules that would apply.
Okay, good to know. And then Dee, one quick question for you. We keep getting pinged on where exactly are the credits calculated, and what forms are required? Where do they remit those?
They're reported on the Form 941. It was updated in the second quarter to include a section for the employee retention credit. It would be calculated in your payroll program. If your payroll program does not calculate it, you can manually calculate it. Particularly in 2020, it's a pretty straightforward calculation.
Okay, thanks for those.
Mm-hmm.
All right, so on this slide here, we are still on the definition of qualifying wages, right? So once you determine which wages qualify, there are still some other stipulations. The first being only wages and compensation paid after March 12th, 2020 and before January 1st, 2021 would qualify. So, if you look at that, obviously there's only a couple weeks there in that first quarter that would qualify, and then the wages through the end of the year could potentially qualify for this credit. It would include wages paid to both full and part-time employees. Again, that full-time employee equivalent just for purposes of the large employer test. Wages paid to any employees would qualify for the credit. Qualified wages would also include an employer's qualified health plan expenses. And then, there are a few other stipulations. One that's pretty notable is that you cannot include wages paid by an employer to employees who are related individuals. And this goes back to one of the, affiliation tests that's out there. But if you're an owner of a closely held business and you have, sons or daughters working in the business or other family members in that business, wages to those employees may not qualify for the credit. Next slide. So I guess we just kind of touched on this a little bit already. The ERC can be claimed by reducing your payroll tax deposits, and you can reconcile everything out on your quarterly payroll tax returns. There was an opportunity to file a Form 7200 to receive an advance payment of that credit, but that ship's probably sailed for when we're talking about at least the retroactive credit in this case. A couple other notes here on the next slide. Yeah, so here's where the income taxation comes into play. Now, there's a reduction in the wage expense required under ERC Section 280C that basically says no deduction would be allowed for the portion of the wages paid equal to the sum of the credits claimed. So you're not going to be able to get a double benefit by deducting wages in an amount of the credit that you receive. So, you're probably already doing this for book purposes, because when you receive those credits on your 941, if you're going to credit the wage expense most likely, or the payroll tax expense. So that's going to result in taxable income by way of reduction in wage expense, which is common for some of these employment credits. And then the last point here before we move on, can you go back one slide, please? So there is an election in the CARES Act that allows an employer to elect to forego the ERC for any calendar quarter that they may have qualified. And it was designed just, you can elect it just by not claiming it on the tax return. So if you missed a quarter and you don't want to go back and change anything, you would be deemed to have made this election just by not reporting the ERC on that tax return. And the only reason I bring this up is this was changed in one of the sections that we're going to talk about, and I think it provides a little bit of insight into how the IRS might, or how the Treasury might interpret some of these elections going forward, and how, since we don't have any guidance yet, what was done under the CARES Act may shed a little bit of light onto how we're going to make some of these elections under the new rules. So
Dee, quick question here for you. What about professional employer organization, PEO? How does that work? We get that.
So again, I'm going to say there's guidance on the IRS website for that. It does apply differently than to an actual employer. And I'm not sure of all of the interplay on that.
Greg, quick question for you. We get this a lot too. What about, and I know you touched on this briefly, but they're asking for some clarification on owners and shareholders and how those wages might work, and also if a sole proprietor might be eligible.
Yeah, the sole proprietor, I'm not sure on. I believe that is addressed again in the guidance. Now, the employee owner would be considered a related individual under the rules. It's a greater than 50% threshold. If you're an owner of a corporation and you own indirectly or directly greater than 50%, then you would be deemed related to that corporation, to that employer. All right, so now that we've made it through the original rules under the CARE Act, we'll look at the first section of the Consolidated Appropriations Act, that Section 206, that made the retroactive changes to the ERC. So, the big one here is this first bullet point. It improved the coordination with the Payroll Protection Program. So now any employer who received a PPP loan will be eligible to also claim the employee retention credit. The catch is that the same payroll costs may not be used for purposes of the ERC and the PPP loan forgiveness application. So the way that they actually wrote this into the bill is they put a new clause in the PPP section that said, the payroll costs eligible for PPP loan forgiveness must be reduced by any qualified wages taken into an account in determining the employee retention credit. So, based on that, it almost establishes a default ordering rule where if you have the same qualifying wages in the same period and you claim those wages for ERC purposes, those must reduce what you're using for your PPP loan forgiveness application for that same period. Next slide, please. But then they follow that up with an election in the very next section here, that employers may now elect to not include any amount of otherwise qualified wages for purposes of the ERC. So basically it's saying, even if you had wages that qualified, you can elect not to include these wages for purposes of the ERC. And presumably that's designed to preserve the payroll costs for PPP loan forgiveness. So if you're looking at, you have a certain amount of wages and you don't have enough to qualify for both, or they fall in different periods, there should be some flexibility here as to what wages you can use for PPP loan forgiveness and then for what you'd use for the ERC. And if you have more than enough wages for both, the thought is you may have a good chance at maximizing both opportunities.
And Greg, real quickly on this, I mean, I'm obviously more a novice here, but if I'm thinking about this correctly, right, you would really want to use the PPP monies first if you can, because that's dollar for dollar forgiveness, obviously.
Right. It might come down to where this is included here just as kind of a technicality to where, if you've already filed a PPP loan forgiveness app and reported wages on there, that you don't have to go back and make an adjustment. You can, be either deemed to have made this election, kind of like, the election that we just talked about, or if you have to affirmatively make an election to say, yeah, no, I want to use those wages, that payroll cost for PPP loan forgiveness, I'm foregoing using that for the ERC purposes. So we'll have to see how that all plays out.
Yeah, absolutely. More to come on that. And Dee, quick question for you. We keep getting this one that related to 941s that have been obviously already filed last year. Should folks, go ahead and amend those? What's the best approach, or do we have a good answer for that at this point?
Well, it's going to have to be analyzed on an individual basis. Obviously, if they have enough wages for the PPP loan forgiveness and still have wages that would qualify for the employee retention credit, yes, I would say they would amend the 941 returns. That guidance came from the IRS with the original CARES Act. It hasn't been updated for the CAA, but I can't imagine that it's changed. So yes, they would amend prior returns to claim the credit.
And we talked about that in an upcoming slide here as well. So a couple other retroactive changes that are notable. It did clarify that the group healthcare expenses are considered qualified wages even when no other wages are paid to the employee. So if maybe employees are furloughed or without wage and you're still maintaining the health plan and making payments on their behalf for that, those could be counted if needed toward the ERC. And the new act also clarified how tax-exempt organizations would determine their gross receipts. And this was already clarified somewhat in the frequently asked questions on the IRS website, but this actually codifies it and includes references to the IRC section 6033, which just governs, the availability of the tax returns for tax-exempt organizations. But again, it's a broad definition of gross receipts, just like the for-profit businesses is. And I guess the main takeaway from this is that your gross receipts as an exempt organization will include your contribution or grant income, as well as your unrelated business income and your investment income. Next slide. And here's so here's how you claim it retroactively. There should be the opportunity to amend payroll tax returns, as Dee had pointed out. There's also a special rule within this section of the CAA that says employers who have already filed their payroll tax returns before the enactment of the act can claim a catch-up credit on their quarter 4 2020 payroll tax returns for all the eligible wages. There's no guidance beyond that, statement as far as how that'll be done. I don't know if they'll need to update quarter 4 forms to implement that change or not, and if payroll companies will be ready. So, we'll talk about this a little bit at the end, but it seems that, we may not have all the guidance we need by the time these quarter 4 payroll tax returns are due. So.
The quick question, we get this a lot. What about, do you have any guidance yet? Obviously more to come, but in terms of coordinating with those third-party payroll providers, what are you hearing in the industry as far as that goes?
Currently, I think the third-party payroll providers are pretty stumped when it comes to updating their software. I think they're waiting for further guidance as well. I do not think they're going to be updating the fourth quarter 941. I think that you would have to report everything in the line that's already on there if you're using the catch-up. But I think that they're just waiting for further guidance from the IRS.
And one question that I'll comment on, forgiven PPP loan is not considered in gross receipts. We do have guidance on that at this point, so I will clarify that.
All right, so everything up to this point has been the retroactive changes to the credit. So that all applies through December 31st, 2020. So every calendar quarter through December 31st, 2020. Now the next section of the CAA amends the CARES Act further, but those changes only apply to quarters beginning after December 31st, 2020. So it effectively is on a go-forward basis. Next slide. All right, so the big thing is that the CAA extended the employee retention credit, which was set to expire at the end of 2020, through June 30th, 2021. So basically we have 2 more quarters of the credit, which for these next 2 quarters in 2021 will be new rules that apply. They also enhanced the credit for this period. So the credit rate is now 70% of qualified wages instead of 50%. And the limit on per employee wages is increased. So instead of 10,000 for all quarters per employee, it's 10,000 per quarter per employee. So if you do the math, the maximum credit we have under this extension right now would be $14,000 per employee. It's 70% of $10,000 wage cap times the 2 quarters that it's extended for. So obviously that's up significantly from the prior rules. Next slide. And then the CAA also enhanced the eligibility requirements for 2021. So employers are now eligible for the credit for any quarter in which gross receipts are less than 80% of the comparable quarter in 2019. And a couple important points here. So this is increased from that 50% threshold that we talked about under the original CARES Act. So you only need to show a 20% decline in gross receipts for a quarter to be eligible now under that significant decline test. And one of the other things to note here is that you're still comparing the quarters to 2019. You don't go back to 2020, which could be important because obviously, if you were impacted significantly by the pandemic, 2020 is probably going to look a lot worse than 2019. So that's an advantage there. The other interesting thing with this is it kind of removed that entire test for significant decline in gross receipts as it existed under the CARES Act. So if you remember, I was saying it had a start and an end period, and it started when you dip below 50%, and then when you restored 80% of your gross receipts, it ended. Now it's a quarter by quarter determination. So even if you don't qualify in one quarter, you might qualify in another quarter. It's just any calendar quarter in which gross receipts are less than 80%. I think that's important because it seems as though this was set up, it's only extended through the first 2 quarters, but it seems as though it's set up to be easily extended if we should get some further stimulus legislation in the future. So, maybe Congress is hopeful that we'll be turning the corner on the pandemic after the first 2 quarters and this won't be needed anymore. But if not, it would be, stands to reason it would be pretty easy for them to write this into a future bill that just says the ERC is now extended for another 2 quarters, and it would be real easy to work that into something, and we'd already have the rules in place. Maybe I'm giving our lawmakers too much credit there, but that's one of the takeaways I had from it.
Careful there, Greg. Yeah. Overall commentary here. I mean, they did try to, I guess, simplify what this for folks so that it'd be a little bit easier to measure and calculate. And these are calendar quarters, correct?
Yeah, everything's, since it's a payroll tax credit, everything's based on calendar quarters. So, if you're a fiscal year entity, it'll be a little bit interesting because you're going to actually span, the old rules and the new rules within the same taxable year potentially. And then the last bullet point here. Oh, go ahead.
I'm sorry, we get this question a fair amount. What about if you've got a business that was perhaps newly formed or can't go back and measure, say, 2019? Any guidance there at this point?
Greg, do you have a slide on that in here?
I don't, but the Act basically says that you can use 2020 as the measuring stick instead of 2019 if you weren't in existence in 2019. So that is addressed within the rules. So the last bullet point here, again, enhanced eligibility is one of the themes here. They allow now certain government entities to qualify for this credit, including colleges, universities, and organizations that provide medical or hospital care. Next slide, please. All right, so this is an interesting election that's in the new rules as well. Employers may elect to satisfy the gross receipts test by using the immediately preceding calendar quarter and comparing that to the same quarter in 2019. So for example, in order to qualify for the first quarter of 2021, as an eligible quarter, you could compare quarter 4 of 2020 to quarter 4 of 2019. And if you had, more than 20% decline in gross receipts for that prior quarter, that would make your quarter 1 of 2021 eligible. And I think the reason for this is just so taxpayers can have some certainty as to whether or not they're going to qualify for the credit, for that period. That way they can withhold on their payroll deposits accordingly and kind of get that cash in hand sooner than later, than waiting around to see if they qualify. And that's going to be a quarter by quarter election. So there should be some flexibility there. And then, so another big thing here is that full-time employee threshold for determining qualified wages, that was increased from 100 full-time employees to 500 full-time employees. So now, larger organizations can qualify for this credit on wages that are paid to their employees, regardless of if they're working or not. If they're over the 500 full-time employees, then you still have to only look at wages that are paid to employees who are not providing services. Next slide. And again, so claiming the ERC in 2021 will be similar to the methods we've already discussed. In the Act, there is actually a new option for an advance payment written into there. And this is only for the smaller employers, so under 500 full-time employee equivalents. And this allows an advance payment of the credit in an amount not to exceed 70% of the average wages paid by the employer in a calendar quarter for 2019. So you basically can look back on data that you already have and calculate a maximum credit and request an advance payment of that if you think you're going to qualify. Like any other credit that you get paid in advance, you're going to have to reconcile this at some point with actual, and if you receive too much, you'd have to pay it back. There's really no guidance as far as how you would elect or request that advance payment at this point. So that's something that we're waiting on.
Greg, quick question we get about clarification for larger employers over 500.
Yeah.
Is what considerations do they have for those larger employers?
Yeah, so if you're over that test, whether it was the old test was 100 for 2020, or if you're over the 500 employee test for 2021, it really comes down to determining what wages you can qualify for the credit. So if you're over those thresholds, you can only count wages that you pay to an employee who is not providing services to you. Even if it's a reduced amount of services, it doesn't matter. So basically, if you're paying an employee to stay home, is the only thing or if you have a periodic shutdown and everybody's at home, but you continue to pay them, well, those wages would qualify. If they're coming in and, you know, doing something maybe they wouldn't normally do, painting the warehouse or, you know, sweeping the floors, they would still not qualify in that case.
And Dee, can you comment on, we get this quite a lot, this question about what really qualifies as a shutdown? You know, is it partial, or, you know, how do we deal with these kind of issues that are not quite so clear?
Well, that is a full or partial shutdown due to a government order, which is different than what Greg was just talking about. So, you know, if the government order, for instance, in Pennsylvania, they still don't have dine-in restaurant services. So those businesses are still partially shut down by a government order.
Right. I think on that too, if you're an essential business or were deemed an essential business when a lot of those shutdowns were happening, it's going to be a lot harder to qualify under that rule. You might want to look at the significant, you know, decline in gross receipts test, but there are some instances that are outlined on those IRS frequently asked questions that say, you know, even if you're an essential business, but some of your suppliers were shut down and they weren't able to deliver crucial materials to you so you can continue, you know, working during the normal course of business, then you could potentially qualify under that shutdown order.
And Dee, one other quick question for you before we move on. We seem to have heard from a lot of folks that the actual payment or receipt of this credit has been pretty slow. Have you heard anything along those lines?
Yeah, I would agree with that, particularly anybody that qualified for it in the second quarter, which was the first one that was available. A lot of clients are getting IRS notices from the Integrity Verification Department, and they're being required to provide very specific information about the business before these credits are actually being refunded to the employers.
Wow. All right. So just a couple more points here, and then we'll kind of open it up for questions and talk about some of the questions that we have and some potential opportunities. There's one thing to be aware of in the section 207 of this act that basically, you know, is the act that applies to 2021. There is a provision in there that expands the denial of a double benefit for certain wages taken into account for other tax credits. So basically what it says is, if you use these wages for ERC purposes, they can't be used for purposes of all the other credits listed here and on this slide. And these are all specifically listed in the act. So, you know, to the extent it's not listed here, it may be unaffected. But one of the big ones is that very first one, the R&D credit. So, you know, wages are a big component of that. So you want to be cognizant of the fact that you shouldn't be taking the R&D credit and the ERC on the same wages to the same employees. So you may have to end up adjusting your R&D credit calculations if, you know, you determine that the ERC is more beneficial. But again, those rules only apply to 2021, so you can kind of kick the can down the road a little bit on that, where your 2020 R&D calculation probably won't be affected by this stipulation. All right, any other questions before we move on?
I think we've addressed a lot of them thus far, Greg and Dee, so I'll let you guys go ahead.
Sure, okay, so, you know, opportunities, next steps, what does all of this mean? You know, the big thing for me, I think the main consideration is, you know, if you're an entity that may be eligible for this, you really need to go through and determine what your eligibility period is for both 2020 and then kind of looking forward to 2021 based on those rules that are outlined. You know, start compiling that quarterly data to see if you can do the analysis and come up with whether or not you experience a significant decline in gross receipts, and then, you know, what's the duration of that period that you qualify. At that point, you can kind of take a look at your wages, qualifying wages paid during that period, and, you know, get an idea of what type of credit you might be eligible for. Because really that's going to be the starting point for all the additional analysis, especially related to PPP, right? So if you only qualify for a $5,000 credit, it's not going to be worth, going through a whole process to coordinate with your PPP loan forgiveness or anything else. But if those numbers are a lot larger, you might want to really dig into it and try to figure out what the best method would be to allocate those costs around. And like I said, we're really waiting on more guidance regarding the coordination with PPP loan forgiveness. And I think there are a lot of questions there as far as, if you've already filed or if you haven't filed yet, maybe you want to wait a little bit to file that application. The CAA that was passed here at the end of December also expanded the non-payroll costs that apply for the PPP loan forgiveness. So there may be an opportunity to allocate more of those costs and less payroll if it really matters. It might be that you have enough wages to go around and it won't really be an impact, but you definitely want to consider all those different options. And then also, keep in mind that the PPP 2.0 is subject to the same rules. So if you're looking at taking out one of those loans and maybe potentially claiming the ERC over the next 2 quarters in 2021, make sure you coordinate that ahead of time now that we know.
Yeah, Greg, and that's a great point. I think that's critical because we've seen getting a lot more questions, obviously, with PPP 2.0 or second draw here. The attestation that's required, remember that that's a key part of this. And that states that, the loan is necessary to support the ongoing operations of the business of the applicant. So, if you think about that, we're in much more of a, I would say, quote unquote, known economic environment where we were in March, April timeframe of 2020 when we didn't, nobody knew where any of this was headed. So I strongly consider, that part of the attestation that you have to provide as it relates to the PPP. So there's just so many considerations here, when you look at this. So a couple of questions here too. If you only, if you used up the payroll, say in 8 weeks or 12 weeks or 14 weeks with related to PPP 1.0, what about using, remaining wages? Again, this is that kind of bifurcation between the PPP and the employee retention credit. That's any overarching thoughts there?
Yeah, I think that's definitely a possibility. And again, the key would be to make sure that as an employer, you qualified under one of those 2 tests, whether it's the shutdown test or the significant decline in gross receipts for, the duration of that period that you're looking at, because it may be, a pretty easy calculation where you just forego the wages for the first part of the year that you would have used for PPP loan forgiveness. Once those are exhausted, then you still have qualified wages left over. And
right.
It seems that they've written that into the text of the bill to where you can make that election to, you don't have to claim the first wages that were paid. You can claim any eligible wages and forego some of those wages to use for the loan forgiveness app.
And Dee, what's been your experience thus far as you've gone through some of these employee retention credit applications and the stuff that you've looked for, at least as it relates to 2020?
Well, one of the things that I wanted to add actually to my last answer regarding how slow they are to get the refunds. If you have the opportunity then to use the prior quarter analysis for 2021, for instance, you can use the 4th quarter of 2020 versus the 4th quarter of 2019 to see if you qualify. You can reduce your payroll tax deposits in anticipation of that credit, each pay throughout the quarter. Now, we had a situation where we did that in 2020 and it didn't work out because they ended up getting an endowment at the end of the quarter that put them over the limit. But with this adding the prior quarter for 2021, you should know or are potentially able to know ahead of time if you do qualify for that. So then you can retain your money each payroll as opposed to requesting a refund at the end of the quarter or using the Form 7200 to request an advance payment.
Always better to, do it that way, of course, rather than trying to go back and get money after the fact. Gross receipts, we tend to get this a lot. I know we've been through this with PPP, and Greg, as you suggested, it's a pretty comprehensive definition in terms of what gross receipts is. And the other thing I'll remind people is that it goes to the typical method that you use for that on your tax returns. In other words, if you're on an accrual basis, you can't all of a sudden say, well, I'm going to use cash basis for this purpose to try to game the system. There's none of that allowed, right?
Right. It's pretty clear on that, especially, as it relates to the employee retention credit. I think it was a little bit less clear with some of the language in the PPP documentation, but, at the end of the day, this should all be a consistent, gross receipts test that you're using for all these different provisions under these acts.
And another question regarding the interaction of the PPP and the employee retention credit. Obviously, again, each different scenario is very fact specific. So I would encourage you to really work closely with your professional in terms of looking at this. And Dee, maybe you can talk a little bit about that process, what that might look like in kind of walking through, okay, here's where the wages might be more useful for, the employee retention credit versus the PPP and how that works.
So in my opinion, I don't really think that there's going to ever be a situation where the wages are better used for the employee retention credit than the PPP forgiveness, because the PPP is a dollar for dollar. The employee retention credit is 50%. That being said, because they have opened up other non-payroll costs that can be used towards the PPP loan forgiveness, I would recommend, if you haven't done your application yet, maybe looking at that and seeing if you have other expenses that can be used towards PPP forgiveness. When you get to 100% of that forgiveness, any wages left over then could be analyzed for the employee retention credit.
Right, I would agree with that statement. Like, there's no scenario I can see where you'd rather use it for ERC purposes, but hopefully there's opportunity to claim both for a lot of folks. And one of the other things is it's going to be a lot harder to qualify for the retroactive credit in 2020. That the tests there are a lot harder to qualify under. So you may take a look at this and it's not going to really matter because in 2020 you didn't see that significant decline in gross receipts. But what I'm more, I guess, excited about would be the prospective credit, where a lot more people will be eligible for this. And one of the things that Doug had just mentioned is there's unlike the PPP, there's no necessity requirement here. If you meet these mathematical definitions of the significant decline in gross receipts and you've paid the wages, you should be entitled to the credit. So that really doesn't come into play here as long as you meet the other eligibility requirements.
Right. If you're asked, it's a great point, Greg. And this is one of the things we've been trying to remind folks as it relates to that second draw or PPP 2.0 because of that attestation. So, it may be that your most, let's just say, risk averse scenario would be is if you did the original PPP 1.0 and you're looking at this now again, and it's, pretty bright line test in terms of qualifying for the employee retention credit here in 2021. If you're a little more risk averse, it might be worthwhile in taking that approach rather than, again, trying to go for PPP 2.0 if your business wasn't quite as severely impacted. Obviously, for those that, and we're well aware of those industries that have just, major significant impacts, it's a different scenario. But each case is just so different with this, and it's just so nuanced with the interplay here between the PPP and the employee retention credit. What about, we get this question, if somebody didn't apply for PPP or something like that. Obviously, there are a number of businesses that weren't eligible for that. The employee retention credit is obviously still there for them. Dee, and in your experience, what have been the businesses that have been most likely to benefit from the employee retention credit that you've seen?
Retroactively, I would say probably the restaurant industry, the service industry, hair salons, nail salons, they were significantly impacted, but they did receive PPP funds. Usually, I would guess that those PPP funds would be exhausted pretty quickly, and then they would qualify retroactively for the employee retention credit for 2020.
And Greg, what about you? Have what have you seen or scenarios that you've kind of modeled through that where perhaps makes most sense for folks? Any overarching guidance there?
Yeah, I mean, so we've had some clients that weren't in those industries, but they've just had a significant decline in gross receipts and been able to qualify under that test. And maybe, they were too large to receive a PPP loan or had some affiliation, that it just didn't make sense for them. Again, you have to kind of wrestle with the rules with the large employer. So only certain, limited amount of wages will qualify if you're a larger employer. But we definitely had some clients that qualified for that. And even though they're an essential business and weren't technically, shut down by a government order. So.
Certainly makes sense. What about timing in terms of additional guidance? Are we hearing anything yet? Either of you have commentary on that?
I haven't really heard anything as far as further guidance, particularly from the IRS. They've been pretty silent.
Yeah, so in the new act, there's actually a section in there that is requiring Treasury and the SBA to conduct a public awareness campaign about this. So that kind of tells me that, they obviously want people to take advantage of these changes. I don't know what that's going to amount to. One of the stipulations in there was that they would have to provide to employers some educational materials within 30 days. That's probably just going to be like a white paper type of thing, but I don't know if there'll be substantive guidance. But by the end of this month, there should be at least something coming out of SBA and Treasury regarding these changes. As of now, the IRS frequently asked questions, which I've referred to several times in this presentation, aren't updated for the new rules. So just be aware of that. There's a giant disclaimer.
There's a little blurb that says we're aware of this, but we haven't done anything about it yet.
Right.
So in essence, the lesson here is okay, they kind of threw all these new rules out here and we're still sort of figuring out how to apply and interpret a lot of this. So I guess with that, we'll preach patience for folks out there. I know it can be frustrating. Believe me, we get frustrated with this as well, but patience is required here. Well, given that, I don't see any other burning questions there. Any final comments? We'll start with you first, Dee, and then go to you, Greg, as we move forward for folks to be aware of and thinking about.
So I like the be patient and understand that each situation is going to require its own analysis. There's not going to be a one for all and all for one approach. We're going to have to look at it individually and then make the best decision for the client.
Yeah, I completely agree. For me, I would say if you want to look at this internally first, kind of come up with your comparison of your gross receipts or look at those other tests to see if you may qualify. I mean, this is this was made retroactive for a reason. Again, Congress wants employers to take advantage of this this credit that exists now. So it may be an opportunity to go back, determine if you qualify, and then that's the first step. If it's clear that you don't, then you can table it and move on. But if you think you might qualify, then get in touch with your advisor, and we can go over some of the nuances and all the different affiliation rules and things like that could impact your business before actually going through with claiming the credit. But the first step is going to be to just take a look and try to quantify what the opportunity might be for your business.
Great advice, and certainly thank you both. Imani, I didn't know if we had any other housekeeping items that we wanted to address before we wrap up a little early here.
Imani may be muted, but in the meantime, I will go ahead and hop on and thank everybody for attending today, and to let you know that we will be sending out a recording of this presentation within the next couple days. We're going to make sure we get a transcript out to you, some additional resources. So if you do, in the meantime, have any questions, please reach out to Greg, Dee, or Doug to get your clarification. If we didn't get to your question today, we will do our best to reach out. But if not, you can always reach out, like I said, again, to us one-on-one. Other than that, I thank you all for your time and have a great rest of the day.